For 9 minutes, the silver market did something it is not supposed to do. Not gradually, not politely, not with confirmation candles or healthy consolidation. It tore straight through technical resistance like it wasn't even there. And the most important part isn't it that silver went up. It is who lost control when it happened. That resistance level had been defended for months. Every rally into it was met with selling. Every breakout attempt was capped, smothered, walked back down. That's how managed markets behave. Pressure builds, price approaches, and the system leans on it until momentum dies. Except this time, it didn't. In a 9-minute window, bids overwhelmed offers, hedges failed, and the wall disappeared. No pause, no orderly retreat. Just a clean, violent push higher that left the model scrambling to catch up. That doesn't happen because sentiment improved. It happens when control mechanisms stop working. And here it skonks the part that should make you pay attention. When banks truly have the upper hand, breakouts don't accelerate. They stall. They fade. They get absorbed. The fact that this one didn't tells you something snapped behind the scenes. This wasn't a technical victory for bulls. It was a structural failure for the system. And once control is lost, even briefly, the market is never the same again. To understand why that 9-minute move matters so much, you have to understand what that resistance level actually was. And more importantly, who depended on it holding. Because this wasn't a random line drawn by retail traders on a chart. It was a structural boundary, reinforced by positioning, hedging, and balance sheet risk across the institutional side of the market. In modern markets, technical resistance is not just a psychological concept. It is an operational one. Large banks, dealers, and market makers don't look at resistance as price memory. They look at it as a risk containment zone. It's a place where exposure is supposed to flatten, where momentum is supposed to stall, and where volatility is supposed to compress back into control. That level existed because massive positions were built around it. Options were written against it. Hedges were layered just above and below it. Algorithms were calibrated to respond to it. Entire books assumed that price would approach that area slowly, probe it, and then retreat. Time, not price, was the bank's greatest ally. As long as silver couldn't clear that level quickly, they could manage risk incrementally. This is why resistance zones matter so much more to institutions than to retail traders. Retail sees a breakout as opportunity. Institutions see it as liability. A fast breakout compresses time, and compressed time destroys risk models. Banks rely on gradual movement to adjust hedges. They rely on liquidity staying present. They rely on counterparties being willing to take the other side. Resistance zones give them breathing room. They allow dealers to sell volatility, rebalance gamma, and keep exposure neutral while the market churns. That resistance in silver was one of those zones. It wasn't just capping upside. It was anchoring positioning. The entire structure above it was thin. There was very little natural liquidity because price wasn't supposed to be there yet. Liquidity was concentrated below resistance, where dealers felt comfortable providing it. Above it, exposure turned asymmetrical very quickly. This is why breaks through well-defended resistance are so different from normal rallies. When resistance is strong, it's not because there are many sellers. It's because there are strategic sellers. Sellers who are there for structural reasons, not opinion. Once those sellers are overwhelmed, there isn't a second line waiting behind them. And that's exactly what made this move dangerous. As price approached resistance, models assumed behavior that never materialized. They assumed hesitation. They assumed two-way trade. They assumed the usual absorption. Instead, buy pressure kept building. Stops didn't trigger gradually. They stacked. Hedges didn't adjust smoothly. They lagged. Liquidity providers didn't step in. They stepped back. This is the key misunderstanding most people have about technical levels. They don't fail because buyers are stronger. They fail because defenders run out of tools. Banks don't defend resistance by dumping unlimited supply. They defend it through positioning efficiency. They lean on option structures. They rely on time decay. They manage exposure dynamically. All of that breaks down when price moves too fast. And speed is what killed this resistance. Once silver pushed into the level with momentum, dealers were forced to react instead of manage. Gamma exposure shifted. Hedging flows flipped direction. Instead of selling into strength, banks had to buy into it to stay neutral. That's the moment control begins to erode. From the outside, it looks like a breakout. From the inside, it feels like a fire drill. This is also why the 9-minute window matters so much. If the breakout had taken hours, control could have been reasserted. Liquidity could have refilled, models could have recalibrated, risk could have been distributed. But 9 minutes is not a trend. It's a shock, and shocks expose structure. The faster price moves through resistance, the less time there is for risk transfer. When risk cannot be transferred, it becomes concentrated. And concentrated risk forces aggressive action. That action often amplifies the very move institutions are trying to stop. This is the paradox of resistance. The more important it is, the more dangerous it becomes when it fails. Because when that wall broke, it wasn't just technical, it was informational. It told every participant watching that something had changed, that the usual suppressive mechanisms didn't activate, that the market did not behave as expected. Once that realization spreads, behavior shifts quickly. Traders stop fading rallies. Liquidity providers widen spreads. Algorithms reduce size. Volatility expectations reset higher. The environment transforms from managed to reactive. And this all traces back to why that resistance was there in the first place. It was a control point, a boundary designed to slow, absorb, and normalize movement. Its failure didn't signal enthusiasm. It signaled loss of grip. This is why banks fear fast breakouts more than slow trends. A slow grind higher can be hedged. A sudden burst cannot. It forces exposure into the open. It reveals imbalances that were hidden under calm conditions. That 9-minute move through resistance wasn't impressive because of its size. It was alarming because of its speed. Because speed tells you whether a system is in control. And for 9 minutes, it wasn't. Once you understand that, you stop asking whether the breakout was real or confirmed. You start asking a more important question. Why was the market so unprepared for it? And the answer leads directly to what happened next. The cascade that turned a technical event into a structural warning. The silver market is now operating in a different regime than it was before those 9 minutes, not because price moved, but because confidence in containment was damaged. Once that confidence cracks, it doesn't fully recover without significant adjustment. You can see this in how liquidity behaves after events like this. It becomes episodic, it shows up suddenly, then vanishes. Depth looks normal until it isn't. Spreads widen faster. Volatility reacts more violently to smaller catalysts. These are signs of a system that is no longer smooth, and smoothness is what banks rely on. Another implication is positional. When control fails at a major technical level, it forces reevaluation across portfolios. Models that assumed capped upside must be recalibrated. Risk scenarios expand. Hedging costs increase. What was once a manageable exposure becomes expensive. That change doesn't just affect silver, it ripples outward. Correlated assets adjust. Cross-market hedges shift. Capital allocation decisions get revisited. All of this increases sensitivity across the financial ecosystem. This is why seemingly isolated technical events can have outsized consequences. They alter assumptions. And markets run on assumptions far more than on facts. That belief underpins much of modern market making. When it fails, even briefly, it forces a fundamental rethink of how risk is distributed. That rethink takes time. And during that time, markets are more vulnerable. This is also why the absence of chaos afterward is misleading. Calm after a structural breach doesn't mean stability, it means caution. That creates a brittle environment where small imbalances can cause large moves. The market didn't explode because banks panicked. It exploded because the system was already stretched thin. It lingers. So the real takeaway from the 9-minute loss of control isn't that silver broke resistance. It's that resistance failed to function as intended. And when core mechanisms stop working, markets don't reset easily. They adapt. And adaptation often involves instability. The breakout wasn't the end of something. It was the reveal of something. A market that looks calm, but no longer behaves the way it used to. And that's the kind of condition where surprises stop being rare. This brings us to the most important question of all. What changes after control is lost, even briefly? Because markets don't reset to their previous state once a structural line has been crossed. They carry memory. They adapt. And those adaptations are what determine what comes next. When banks lose control even for 9 minutes, the entire risk landscape shifts. Not visibly at first, not with headlines or dramatic moves. The system becomes more defensive, more sensitive, and paradoxically, more unstable. The first change is psychological. Control is not just mechanical, it's perceived. As long as participants believe that certain levels will be defended, behavior conforms to that belief. Once that belief is broken, even temporarily, behavior changes immediately. People stop assuming protection. They stop leaning into resistance. They wait. Waiting sounds benign, but in markets it creates vacuums. That means stops, hedges, and forced adjustments play a larger role in driving movement. Direction becomes less about opinion and more about constraint. And constraint-driven markets are prone to sudden acceleration. The second change is structural. After an event like this, banks don't rush back to reassert dominance. They reassess exposure, they tighten limits, they widen acceptable ranges. This reduces the amount of passive liquidity in the system. Fewer resting orders, thinner books, more air pockets. This is where the danger really lies. They don't need macro shocks or dramatic catalysts. They move because imbalance alone is enough. A modest surge in demand or supply can produce outsized price changes because there is nothing there to absorb it. This is why post-breakout periods often feel deceptively calm. Price may drift, volatility may compress, but the underlying structure is weaker than before. The system is operating with less redundancy, less margin for error. The third change is behavioral at the margin. Participants who rely on stable, controlled conditions, volatility sellers, carry traders, structured product desks, become more cautious. Some reduce exposure. Others demand higher compensation for risk. That raises costs across the board. Hedging becomes more expensive. Protection becomes scarcer. Momentum traders, volatility buyers, and fast money algorithms thrive in environments where structure is compromised. They don't need control. They exploit its absence. This creates asymmetry. Upside and downside both become sharper. Moves become less orderly. Price spends less time consolidating and more time jumping. This is how markets transition from managed to reflexive. And reflexive markets don't move because of value. They move because of feedback. Price changes behavior. Behavior changes price. And the loop feeds on itself. Silver is now closer to that state than it was before the 9-minute event. That doesn't mean a straight line higher. It doesn't mean a crash. It means unpredictability increases. It means the distribution of outcomes widens. It means surprise becomes more likely than continuation. This is why focusing solely on direction misses the point. The real change is in how the market will move, not necessarily where it will go. Fast moves become more common. Gaps become more likely. Liquidity disappears faster than expected. And once a market shows it can move uncontrollably, participants stop assuming it won't. There's also a timing aspect that matters. Structural damage doesn't always express itself immediately. And confidence has partially returned. That's when exposure creeps back in. That's when positioning rebuilds on a weaker foundation. Then something small happens. And the reaction is not small at all. This is why moments like this are inflection points, not conclusions. The 9-minute loss of control wasn't at T the climax of the story. It was the warning shot. It told you the system is tighter, thinner, and less forgiving than it appears. Banks losing control briefly doesn't mean they're powerless. It means their margin for error is shrinking. And shrinking margins lead to sharper reactions. From here on, silver doesn't need permission to move. It's already shown that containment is not guaranteed. That knowledge alone changes the game. So when you watch silver next, don't just watch price. Watch speed. Watch how quickly liquidity appears and disappears. And watch how violently the market reacts to relatively small triggers. Those are the signals that matter now. Because markets don't announce regime changes. They hint at them. And silver just did, in 9 minutes. Once that resistance failed, the market didn't transition. It reacted. And that distinction matters, because transitions are controlled. Reactions are not. What followed was not a continuation of buying interest or a sudden burst of optimism. It was a mechanical chain reaction that unfolded faster than human decision-making could keep up with. The first thing to understand is that markets don't break all at once. They break in layers. The top layer is visible. Price moving, volume surging, headlines forming. But underneath that are the hidden systems that actually determine whether price can move smoothly or violently. When silver cleared resistance, those systems began to fail sequentially. The initial trigger was stop activation. Above resistance sat a dense cluster of protective stops. Not from retail traders, but from institutions that had structured short exposure around that level. These stops weren't opinions. They were safety valves. And when price punched through, they fired simultaneously. That sudden wave of market buy orders removed what little resting liquidity existed above the level. At the same time, dealer hedging models flipped. Dealers who had been short calls or positioned to benefit from stagnation suddenly found themselves exposed to accelerating upside. In normal conditions, they would hedge gradually, but speed destroyed that option. As price climbed, gamma exposure increased, forcing dealers to buy more silver just to stay neutral. This is where the move began feeding on itself. This is the moment most people misunderstand. It wasn't buyers chasing price higher, it was defenders being forced to chase it. Liquidity, which had been abundant below resistance, evaporated above it. Market makers widened spreads or pulled quotes entirely. Not because they wanted to, but because they couldn't price risk accurately in real time. When models lag reality, participation drops. And when participation drops, price jumps. As bids lifted and offers thinned, algorithms designed to exploit momentum detected the imbalance. These systems don't analyze fundamentals or sentiment. They respond to velocity. The faster price moved, the more aggressively they joined. But they weren't adding depth, they were adding pressure. This is how cascades form. One system's defensive action becomes another system's signal. What started as forced hedging quickly turned into a feedback loop. Meanwhile, counterparties on the short side began pulling back. When exposure becomes unpredictable, the rational response is to reduce size. But reducing size in a fast market means crossing the spread, which pushes price further. Every attempt to exit increased the move they were trying to escape. This is where control truly vanished. Banks are not omnipotent. Their power comes from structure, not force. They manage markets by distributing risk across time and participants. But when time compresses and participants retreat, that structure collapses inward. Within minutes, the market shifted from balanced to one-sided. Buyers didn't need conviction, sellers needed relief. That asymmetry is what creates violent moves. The 9-minute window mattered because it was too short for stabilization. No new liquidity entered, no new sellers materialized. The only available flow was reactive, stops, hedges, and algorithms responding to price, not shaping it. This is also why the move felt clean. There was no chop, no hesitation, no two-way trade. Those are signs of control. Their absence is telling. Behind the scenes, risk managers were scrambling. Value at risk thresholds were breached. Position limits were tested. Some desks froze activity entirely, not because they wanted to exit, but because they didn't trust the market to function normally. When risk controls override trading systems, liquidity doesn't just decline, it disappears. And that disappearance feeds back into price behavior. Without depth, even modest orders cause outsized moves. The market becomes hypersensitive. This is where the idea that banks lost control stops being metaphorical. Control in modern markets is not about direction, it's about containment. It's about ensuring that price moves in a way that allows risk to be managed. Once that containment fails, power becomes relevant. What followed was not a rally. It was an exposure unwind occurring at machine speed. Every participant was reacting to a different constraint. Dealers to gamma, shorts to stops, algorithms to momentum, risk managers to limits. None of these actors were coordinating. They were colliding. This collision is what makes these events so destabilizing. No single entity is responsible, and no single entity can stop it once it starts. The system becomes reflexive. Price drives behavior, and behavior drives price. And when reflexivity dominates, markets overshoot. The fact that this happened in 9 minutes tells you something crucial. The market was already fragile. It didn't take a macro shock or breaking news. It took a technical level failing faster than expected. That's all. This is why experienced institutions fear speed more than direction. Speed removes optionality. It forces binary outcomes. You're either in or out, hedged or exposed. Most systems are not built for that kind of compression. By the time the move exhausted itself, the damage was already done. Positions had been reshaped. Liquidity providers had stepped back. Volatility expectations had been reset higher. The market was no longer in the same regime it was in 10 minutes earlier. Control wasn't lost because banks were wrong about silver's value. It was lost because the system was too tightly wound to absorb a sudden release of pressure. And once you see that, you realize the breakout wasn't the story. The story was how quickly the machinery failed when tested. Because markets that are truly under control don't unravel in 9 minutes. What that 9-minute event really exposed wasn't just a momentary lapse in control. It revealed the underlying condition of the silver market right now. And that condition is far more fragile than the surface price action suggests. Because when a system fails under a relatively modest test, the problem isn't the test, it's the structure. In a healthy, well-balanced market, resistance doesn't vanish, it bends, it absorbs. Price pushes into it, stalls, pulls back, and tests again. Liquidity thickens, participation increases. The market communicates. That's how discovery works. Now what happened here was the opposite. Resistance didn't negotiate, it collapsed. And collapses only happen when the scaffolding behind the wall is already compromised. This tells us something critical. The silver market was operating with very little excess capacity. There was no buffer, no redundancy, no deep pool of willing risk takers ready to step in when the level was challenged. The system was running tight, optimized for calm, not stress. That optimization is a warning sign. Modern markets are built to maximize efficiency during normal conditions. Capital is deployed precisely. Liquidity is provided where it's expected to be used. Risk is sliced thin and spread wide. This works beautifully, until it doesn't. When conditions change abruptly, efficiency becomes vulnerability. There is no slack to absorb shocks. Silver's resistance break showed us that slack is gone. The lack of follow-through defense suggests that large players were already constrained, balance sheets were already stretched, risk limits were already close to binding. When price accelerated, there was no appetite or ability to increase exposure in the opposite direction. Defending the level would have required taking on risk when risk tolerance was already exhausted. That's not a tactical failure, it's a systemic one. Another revealing aspect is what didn't happen afterward. There was no immediate, aggressive reassertion of control, no sharp reversal, no heavy absorption to force price back below resistance. That absence speaks volumes. If banks had both the capacity and the confidence to reclaim control, they would have acted quickly. Delay in these situations is not strategic, it's cautious. Caution from institutions is rarely about price, it's about uncertainty. Uncertainty about positioning, about counterparty exposure, about liquidity reliability, about how much stress the system can still absorb. When those questions arise, participation shrinks. And when participation shrinks, control becomes illusionary. This also reframes how we should interpret the breakout itself. It wasn't a declaration of strength. It was a stress test that revealed weakness, not in silver, but in the market structure around it. That distinction is essential. When banks lose control temporarily, they don't immediately try to dominate again. They reassess, they reduce exposure, they widen margins, they shift behavior to protect capital. That protective posture changes the market's character. It makes future moves sharper, less predictable, and harder to manage. This is how regime shifts begin, quietly.